Hello and thanks for joining us at interest.co.nz. I'm Janae Tibbs-Rainey and today I'm joined by Reserve Bank Deputy Governor Christian Hawkesby. Thanks for your time, Christian.
Kia ora.
Look, since the Reserve Bank released its monetary policy statement, things have really, the world once again has changed in terms of what's happening in Russia, what's happening in the Ukraine, I should say, with Russia. Christian, could you give us a sense of whether this changes the Reserve Bank's outlook at all, or its view of inflation?
Yeah, so going into the monetary policy statement and the decision last week, we knew that there were a number of sort of risks around that we were weighing up as we made our decision. There was obviously uncertainty about the impact of how much conditions had tightened locally and how much that was feeding through. There was uncertainty about how the New Zealand economy would cope with Omicron in the weeks and months ahead, and the conflict and geopolitical tensions in the Ukraine were another risk that we were weighing up. Markets had put a reasonable probability on this crisis or this amount of geopolitical tension brewing. So some of that was priced in. I think given what's happened since the statement, we're just going to have to reassess as we do every 6 weeks about what the implications are for our mandate. The near-term implications will be if oil prices stay where they are at the moment. That's higher than we had projected in our monetary policy statement. So, the very near-term implication is that we will have higher CPI outturns over the next quarter or so than we had factored into our statement. So the key judgment for the Monetary Policy Committee will be we can't control that. It's happened. It's come from overseas. What does that then mean for the outlook for inflation going forward? And that's the thing that we really need to stay focused on. We are in an environment where locally inflation expectations have been rising, in part because what people have seen with recent headline inflation. So the key question will be, how much of that spills over into higher inflation expectations further out in the window where we, can make choices about leaning against that or not.
We're hearing news out of international news about interventions being made with the SWIFT system that sort of settles financial transactions around the world, and basically just looking at different ways that the world's trying to put pressure on Russia. What are the implications of this for New Zealand? There's obviously a lot of instability and a lot of things are moving very quickly, but how does it affect us here?
Yeah, so SWIFT is a messaging service that banks around the world use to make and receive payments. It's a key part of interbank payment systems right around the world, including our own, the ESAS system. So it's an important part of the financial plumbing, and the actions that the international coalition are taking are ways to disrupt the Russian economy by making it more difficult for them to participate in financial markets and in the global financial system, and they're doing that by having sanctions on their use of SWIFT as a way to make payments. That's going to have there are a number of different channels to think about. I mean, one is that we don't have any Russian banks within our payment system, so there's going to be no direct impact there. There will be New Zealand exporters who have relationships with Russian customers, and that they'll have to think about how their payments are going to be received. The more immediate issue is just the way the sanctions around SWIFT have the ability to disrupt the financial system and the financial markets more broadly, and that could occur if there was concern that it might create a gumming up of the financial plumbing in ways that we've seen in the past. You think of the Lehman's event or in the initial stages of COVID-19, where you had a gumming up of the plumbing, a rush for liquidity, a rush for US dollars as a way for financial market participants to free themselves of that dysfunction that can create challenges in funding markets. Yeah, so the question really is how much if there is a gumming up of the plumbing in US dollar liquidity, how much does that sort of flow through into our local markets? Because we can provide, as a central bank, we can provide lots of liquidity in New Zealand dollars, take collateral, provide lots of liquidity. There's also things that we can do in the so-called FX swaps and forwards markets, because that seems to be where the problems in global liquidity sort of translate themselves through there. So there are also actions we can take in those markets.
Thanks for that. We'll jump back now to the monetary policy statement that the bank delivered last week. Obviously, balancing the bank's inflation and employment mandate is looking fairly interesting at this point. How much unemployment is the bank, will the bank be comfortable with as it tries to curb this inflation problem?
Well, yeah, so as you mentioned, we've got, we have a dual mandate at the Reserve Bank for low and stable consumer prices and supporting maximum sustainable employment. Since we've had our mandate, those two aspects we think have been aligned and have been giving us similar signals about what we should be doing. And at the moment, with inflation pressures growing and moving into this environment where we feel like we should be removing stimulus and tightening conditions as our actions, consistent with our actions since the middle of last year, that's also in a situation where we think the economy is actually operating beyond maximum sustainable employment. So we think not only do we have inflation pressures, but we have a very tight labour market. We have a lot of capacity pressures. And that's also an environment where we should be removing monetary stimulus and starting to tighten. And so that gives us, some confidence that according to both sides of our mandate, we should be moving in the same direction. We've got the unemployment rate rising through the course of our projections. Partly that's because we have record low unemployment at the moment, very tight labour market. That rise in unemployment we think come through two potential ways. One is the mitigating the way that we're going to be slowing demand down in the economy and the way that will eventually translate through into the labour market, but also the way that the supply of labour is likely to rise over our projection period as the borders free up and we move from this period where we've had effectively zero net migration back to a more normal period where we have a flow of migrants back into the economy, and that really will be part of our labour market renormalising.
Okay. The bank is undertaking a 5-yearly review that it has to do by legislation, looking at the way it does monetary policy. Basically, one of the things you've said is that you're going to look at the weight given to the employment and the inflation targets that the Monetary Policy Committee has. How are those two things weighted at the moment? You've said that, you've just in your answer before said that those two things have sort of complemented each other and the policy that the bank has been implementing, but how would you characterize the weight given to those two factors? Are they 50-50?
Yeah, it's a great question, and we've we have a monetary policy strategy that we outline at the beginning of our monetary policy statement in terms of the way we do, monetary policy and what we focus on. We've said that we put weight on both, both aspects of our mandate. We haven't gone as far to say give that a numerical number, that we give exact equal weight or some percentage. As I mentioned earlier, over the recent period, the signals, according to our mandate, have been consistent with each other. So we haven't been in this position where we've needed to make a trade-off between the two and have needed to make hard decisions between the two. I mean, I would say that you're looking over the medium term, the importance of low and stable inflation and inflation expectations remaining at target, which is the one numerical part of our target, is our inflation target at 1 to 3%, focusing on 2. That is a really key component and something that does provide an anchor.
Christian, just to talk about the large-scale asset purchase program now, the bank announced that it would start selling a lot of those New Zealand government bonds that it bought when it launched this program at the start of the pandemic. $5 billion of bonds a year it will sell back to the Treasury. You've mentioned that the point of this is largely to clear the decks, for the Reserve Bank to sell the bonds so that should it decide to buy bonds again in the future in another crisis, or if it needs to loosen monetary policy, it might have more flexibility to do that. It might be difficult to buy a whole bunch of bonds when the bank already owns so many bonds that it'll be a super big player in the market. But I guess, there is a trade-off to that. Now, that because the bank wants to clear the decks, what this means is that the Treasury will likely have to issue more debt to buy the old debt back from the bank. Does the bank really need to clear the decks in this way? Is it really that much of an urgent issue that it needs to do?
We think it's the right thing to do. We think that the large-scale asset purchase program was a really, really important part of our toolkit, particularly through 2020, when we'd reached that lower bound of the official cash rate, and we knew that we needed to do more to support market functioning, to keep interest rates low through that period right across the yield curve. And what our research is showing is that that's when these programs have the biggest impact, is that when they're front-loaded, when you're doing them into dysfunctional markets, and that stability that you can create. But then through time, the impact wanes, and we think that the net impact of the large-scale asset purchase program is pretty marginal now. So we think that as we're going into an environment, particularly where we're tightening policy and we're removing, stimulus through lifting the official cash rate, this is a good period to be, making that investment into the future, such that we can use this tool again if and when it's needed. But we need to do that, with very clear principles. So follow the same principles that we did in our way in as we do on the way out, and have very clear objectives around how we design the exit. So, and a couple of key objectives is to have a minimal impact on monetary conditions as we leave, and to make sure that we're supporting, we're not creating a dysfunctional market on the way out. And that second one is particularly where we've consulted with New Zealand Debt Management about, what sort of scale of exit could markets function with quite easily, to ensure that we are continuing to support market functioning on the way in as we did, on the way out.
Okay, in terms of not having too much of an impact, what do you think of the chances of that sell-off putting upward pressure on interest rates? Do you think there'll be a bit of upward pressure?
Yeah, well, I think in theory it should. The fact that we are selling our holdings, the fact that, as you mentioned, while it's a choice for New Zealand debt management, all things else, held constant, you'd expect that would mean that they'd need to access more funding in markets. This should put some upward pressure on longer term interest rates. The question then is, how much was this anticipated by markets? And I think we had, signalled, our intent in some ways that we were looking to gradually manage down the balance sheet. I think it also will depend on other things going on in markets at the time and what the general demand for holding New Zealand government bonds is, particularly from global investors. And the sense we're getting there is that there's very, very favourable global demand to hold New Zealand government bonds, and so that again creates an environment where there's less chance that we're disrupting markets by being a seller on the way out.
Okay, just on that, I mean, when the bank launched the LSAP, the bank's goals aligned with the government's goals or Treasury's goals. Treasury had to issue a whole lot of debt to pay for things like the wage subsidy, and the Reserve Bank was trying to put downward pressure on interest rates in a way that it could do that was through this, through being a really active player in the bond market. So those two goals aligned with each other. Currently, the Reserve Bank's goal is to clear the decks, make it easier for it to potentially use this tool in the future. But I'm still a bit unclear as to what Treasury's goal is. Presumably, it wants to try to keep government debt low because, if the country has lots of debt, that costs taxpayers. But now Treasury is going to have to issue more debt. So these two goals are not, from my perspective, aligning so clearly anymore. So, it seems like the Reserve Bank's getting its way here versus Treasury.
Yeah, so just a few different sort of aspects to that. One is that it will, our actions, underpin that we are an independent, we're operationally independent as a central bank to sort of take the actions that, will support our mandate. And when we first started the LSAP program, we had the indemnity agreement with the Minister of Finance that sort of outlined that if the bank did want to reduce its holdings, it could do so in the future. We just had to talk to the New Zealand debt management, keep in close consultation about that. So yes, it does, I think, illustrate our operational independence that we can do something like this. In terms of the amount of bonds out there, rather than increasing the amount of bonds, it potentially just changes the composition of holdings. So it means that the Reserve Bank holding less government bonds, but potentially other buyers holding more. So I think rather than there being a sort of an aggregate effect, it's more a compositional effect. But it may be that interest rates have to rise a little bit for those other buyers to come in. Where I think that we are still very aligned, as we were on the way in, is this point of market functioning and the integrity of New Zealand's capital markets. And that's where the Reserve Bank and New Zealand Debt Management have always been very aligned, having both having strong incentives in that long-term functioning of our markets, integrity of our markets. And that's why it's really sensible for us to work together to devise an exit strategy to achieve that.
Christian, thank you so much for your time. We'll wrap it up there, but appreciate it. And I'm Janae Tirani from interest.co.nz.